Hey everybody, good to be here today. My name's Brent Moores, and time for long options. You know, you have a lot of different choices when you're trading options. We're focusing on long options, whether we're going, bullish or bearish in the market. You have choices on time frames. You have choices on strike prices, and there's pros and cons to each of those choices. And I want to talk about some of those today. I'm glad to join you, and I see some familiar names in the chat. I'm glad to have you here. And if you're watching on the recording, great. We're glad to have you as well. I'm also very glad to have Mr. James Boyd helping me out in the chat today. So as you have questions, feel free to type those in the chat between James and myself. We'll do our best to get those questions answered. Before I go, need to go through some disclosures, and then we'll get to the meat of the show here in just a sec. But also let me remind you, James and I are both on X. We post additional content throughout the week on X. You can follow us at Brent Moore CS, at James Boyd CS. All right. So just a reminder, options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not an individual recommendation of any security strategy or chart pattern. Schwab does not recommend the use of technical analysis as a sole means of investment research. The paper money software application is provided for educational purposes only. I'm probably not going to factor in commissions in most of the trades that I look at today, and we will look at trades. They're examples, they're not recommendations. But remember, commissions are a part of trading, particularly with options. All investing involves risk, including the potential loss of your principal there. And that's true with long options. You can lose it all. Past performance of any security or strategy does not guarantee future results or success. And there you go. I think that does what we want to do. So let me go and let me pull up our Thinkorswim platform. I thought maybe we just take a quick look at the markets, because you guys were all aware we had the pullback. You can see I actually drew some lines on here the other day, because it seemed on the pullback we were kind of going sideways. And I mean, one of the points I tried to make was, look, we've got this is kind of a new channel we're in. Are we going to break above or below? And we broke above. So I mean, that's kind of a good sign for the bulls here on that. But that doesn't mean all the stocks out there are going up, or that we're going to do bullish trades on everything. We may do a mix, because there's some stocks that are looking more bullish and some that are looking more bearish. But so here's what I want to do. I want to talk about trend trading, different time frames. I saw something in the chat. There's, on time frames. And in the course of this class, we talk about different time frames. We've done 0 DTE before. We've done swing trades. We've done leaps. We do trend trades. I'm probably going to focus more on trend trading today. Just realize that. And so there we go. If you are interested, by the way, I'm going to be talking about trend trading. I did a class on a trend trading sample plan back on January 14th. If it is of interest to you, I'll post a link to that in the chat. You can also get that on the playlist. We post on YouTube, the Trader Talk Schwab channel. And so you can get all the playlists for there. You can get a playlist for this class. This is the January 14th one that I just posted the link to in the chat if you're watching on a recording and you don't see the chat. Also, check out other classes we have, other webcasts we have, including James teaches an Investing Master series on Tuesdays, 11 o'clock Eastern Time. Make sure you check that out. You will not be disappointed on that. Okay, so I want to talk about basically trend trading for the most part today. I want to talk about managing those trades, those trend trades, and I want to focus a little bit on delta here in terms of deciding trades and managing trades, and to do so, I want to use sample trades as an example there for us. Okay, So when I'm doing this, though, when we're looking at this market, and I'm doing technical analysis, there's kind of three main things in terms of technical analysis that I'm gonna focus on. One is, what's the trend of the underlying stock? That's the first thing. Is it up? Then we're probably more likely as technicians to do a bullish trade. Is it down? Down. More likely to do a bearish trade. Or is my sideways? And in that case, there's neutral trades out there, but that's kind of outside the scope of this class. In this class, we're doing long options, which are kind of more bullish or bearish polarity on those. So trend is the number one thing we're looking at in terms of technical analysis. The second thing we'll probably consider is support and resistance. Where is it? And where is it? And also, how strong is it? Because let's be honest about this. Sometimes we look at stocks, we look at trades. Let me just pull up a stock here. So here's Exxon Mobil. Let's say we were bullish on this. Okay, let's say we're bullish on this, and we say, well, we broke out, starting to trend up a little bit. You have to ask, well, is this a resistance right here? Is this a potential resistance right here? And the answer is, yeah, you could probably argue maybe there's a little bit of resistance right here, but you got to ask how strong that resistance is. Because if you take every little bounce that has occurred on the chart previously, you're probably not going to find much in the way of a trade. I mean, unless the stock's at an all-time high and is trending up or something like that. You need to judge how strong that resistance is here on that. And or support in that case. Let's look at Gilead for a second. Gilead, maybe we're sloping down, maybe you're bearish on this, maybe this is kind of a bear flag, maybe you're looking for a close below the low of the high day or something like that. You got to decide, is the moving average going to act as support? Is this support? Is this, there's just a lot of different areas. So you can kind of be like hamstrung to the point of not ever doing a trade, paralyzed, if you will. So you do need to discern as you're doing this how strong that support or resistance is. And then the final thing, I mean, obviously there's a lot of things you can look at technically, but the last thing I'm just going to say, price action or momentum is kind of the last thing we're going to consider. Is that favorable for our trade? Okay, so those are kind of the three principles of our technical analysis that we're going to do, and we'll do that for bullish trades and bearish trades. Okay, let me move that out of the way right now. But I also want to focus on actually one other thing. And let's just pull up a stock to illustrate this. And we'll look at bullish, we'll look at bearish today. So for my bullish trades, I'm going to look at something that has a trend up. AIG has a trend up. We have a series of higher highs, higher lows. And, that most recent bounce right here, we kind of went up, bounce, going up, close above the high, the low day right there, right? So if you were looking at a bullish trade, looking at a long call there, we have different choices. We have choices on time frames, and the choice on time frame is probably largely going to come down to your technical analysis, what kind of trade you want to do. Swing trade, shorter term. Trend trade, maybe we'll go out a little longer term. In terms of expiration dates, when we did our trend trading sample plan that I mentioned already, that was on January 14th, I think it was. January 14th. We said, we're looking 50 days, maybe 100 days to expiration on those. So let's do that. Let's look at AIG. Let's go. Here's 52 days on AIG. I probably don't need this many strikes. But one of the choices is how far in the money or out of the money you're going to do. Last week in this class, we talked about some out of the money trades that were a little bit more aggressive. Well, we're not going to do that here. We're going to go in the money. And one way to determine in the money or out of the money is to look at your delta. This is my delta column. It's a little scrunched down right here. Here's my delta column right here. But when we talk about delta, here's the next thing I want to mention today. Then I want to just kind of look at trades here. But here's delta. Delta tells us on the most basic level, it tells us how much the option moves in comparison to a stock price move, in comparison to $1 move in the stock price. It can tell us how far in the money or out of the money the trade is. In other words, at the money, right? You know, the stock price that's going to be closest to the stock price. So the at the money contract, in this case, the 85, is going to have a delta probably pretty close to 50. That's typically how it is. Same thing with puts, except just put a negative sign in front of that on the puts. Okay. So that's one thing it says. The higher the delta, the more in the money it goes. Same thing with puts, you know, absolute value of puts. The higher the money, the more in the money it goes. The lower the delta, the more out of the money it goes. So by doing that, you can kind of judge how far in the money or out of the money is. Okay. So there we go. So that's another thing delta does. Another thing delta can tell us is, let me just scroll down here, is it can kind of give us an idea of probability. Probability, okay? That's not, it's not an exact measure. You could also, there's also let me get rid of this left-hand column. There's also a column header you could use that's probability in the money. And you're going to notice it actually kind of differs from delta a little bit typically. Sometimes it'll be the exact same, but typically it'll be a little different. But it'll give you a decent ballpark figure typically on that. But, you know, it's probability analysis is not guaranteed in that regard, right? So that's another thing that delta does. And then here's another thing it can do. It can also tell us kind of, I'm trying to think of how to word this, the potential reward for a dollar move and the potential risk for a dollar move. And here's what I mean by that. Let's take a couple examples here. Let's say we have something with I said 40 and I wrote 30. I could say 30, doesn't matter. 40 delta, and let's say we take something with an 80 delta, okay? So if, and in this case, let's kind of put in your mind a call option. If the stock goes up, how much reward do we get on a 40 delta if the stock goes up? Well, if the stock goes up $1, we get about a 40-cent reward on that, okay? On the 80 delta, what kind of reward do we get? We get about an 80-cent reward off a dollar move. In other words, the higher the delta is, doesn't matter where we start, the higher the delta is, the higher reward we're getting. And that's one kind of nice thing on long options, is gamma works in your favor, okay? So I just mentioned the word gamma. Gamma is one of those option Greeks, okay? It tells you how quick, what direction and how quickly the delta moves. But on a long call, for example, what happens is if you buy at a certain price and the stock goes your way, let's say the stock goes up, what's happening to your delta? Your delta goes up. In other words, you reap more and more benefits the more the stock goes up. Same thing with puts. Let's say you do a long put, you do a bearish trade. The more the stock goes down, the higher that delta goes, absolute value of the delta, the negative delta. And so you're actually making more money than you would per dollar move if the stock continues to go your way. That's a beautiful thing about long options, folks. That's a nice thing. The gamma can benefit you on this. In the case of short options, and I don't want to dwell on short options because this is in a class on short options, but that's not the case. You know, if you've ever done a long put, or excuse me, a short put, and the stock goes up, which is great, your delta basically just doesn't do anything. I mean, you've made all you can make on it at a certain point, and it doesn't really, the more it goes, it doesn't help you out more. Okay, so that's one of the nice things here on these. So as the stock goes up and we get up here, that's a great thing. But think about it from the risk standpoint. Let's say you pick a stock, it goes up. Again, thinking from a call standpoint here, the stock goes up, you're making money. What happens to your risk there on that? If the stock reverses itself and we have that 80 delta, we actually can lose a lot of the money quicker than we would if we didn't have that 80 delta, if the delta were lower. So you're actually bringing kind of more risk in the equation of it if the thing reverses on you. You can lose money faster if it reverses on you. And that's one reason when you do a long call and it's going your way, or a long put and it's going your way, you may roll it down to a lower delta to try and help protect you in case it reverses on you. Okay, because the markets reverse themselves sometimes, right? That happens. So for example, in our sample plan that I mentioned, that I went through that class on, I said in our sample plan, we often will start with the delta in the 60 to 70 range. So if I buy this call here, and we're starting with the 61 delta, what's going to happen to that 61 delta if the stock goes up? Well, if this $84 stock goes up to, say, I don't know, well, let's go $4 in the money. Well, let's go about $10 in the money. Let's say that 84 stock goes up to, let's see, 84 stock goes up to 94. What's our delta going to be? Well, I don't know exactly, but $10, this is going to be like $12 in the money at that point. Well, the current contract that's $12 in the money, approximately at least, is, let's see, am I doing my math right here? Is, closer to that 90 delta. Our delta will be much higher at that point. So what we may decide to do is just roll that down, okay? So that's just kind of a risk management possibility that we have here. So let's go and let's do a trade on this. And again, my trend is up, okay? Resistance levels, well, on this 6-month graph, I'm not really seeing anything. Let me go back. We'll go back to 3-year level. I don't see anything up here on 3, so resistance isn't an issue here on this one, I think. Price action, we just had a nice little bounce up, little hold type bounce up right there. That's a classic trend trade there. And there we go. Okay. So let's do, so let's put this trade in. I'm going to go here. I'm going to right click on this and I'm going to buy custom with stop. Okay. And I'm going to put in a stop loss on this as well. Okay. Now, we could do the stop loss based on the option price. We could do it on the stock price. On the option price, let me just see if I can make this a little bigger so you can see it. Here's presumably our entry price around 450. We could put in that stop price, a stop price around, maybe a little bit above the 50% level, maybe around, well, half of 450 would be 225. We can go to 250, maybe up to $3 on the stop there, because we're buying something that's in the money here. So here's what I'm going to do. I'm going to do a $3 stop on this. This is a trend trade, and I'm going to make it good till canceled. Now, the alternative to that is we could put it based on the option stock price, the underlying stock price, and say, hey, if the stock breaks below, say, our recent bounce, let me go to the low of that bounce, about 82.50, we're going to get out of that. If I wanted to do that, I could just go to the gear, click on that. I can make this a market order, good till canceled, and say if AIG marks less than or equal to, I think we said 82.50, okay, and put that in there. But I'm not going to do that there. I'm going to leave this as a traditional stop here. And you can, well, let's click on confirm and send and just take a look. How much am I risking? Well, I'm risking the full thing because this could go to zero. But practically what I'm expecting, hopefully, is this to get stopped out. Hopefully, no guarantees, no guarantees. Hopefully we get stopped out around the $3 mark if it goes against you. So let's go and let's enter this trade. I'm going to enter this as a long single option. I'm going to send, and we filled. Now here's what I want to point out on this. Let's go to that long single option here. Here's my AIG trade, the one we just entered. Now look at our delta. Our delta right now is 80, or 60. 60. If we look at this and monitor this as a delta, and we see that delta goes down to 50, that's probably not a good thing. I could almost guarantee you at that point, if this delta shows 50, we're going to be losing money on this guy. Similarly, and remember, there's a time decay component to it. So if it stays at 60, maybe not so great. But if this is going to go up, and we see this head up more towards the, I don't know, the 75 to 80 level, maybe we get this to 80, what's going to happen? What happens is our profit loss will probably be positive at that point. Okay, good question, Gazelle. We'll get to that in a sec. But our profit loss would probably be in a pretty good position at that point. And if we roll it out, we'll be able to bring in a credit, which would be nice, roll it back down to 60 delta. So in other words, we're starting with the 60 delta. Let's say we get up to an 80 delta. Okay, I get to an 80 delta. Okay, this is going to be a more expensive option. I can then roll it down to back down to a 60 delta, that basically the same conditions we started with the trade. That will generate a credit probably. Okay, that will generate a credit, which is nice. We'll then have a trade with the 60 delta on it. We can keep the same strike, same expiration date on that. But it also serves to do what we mentioned before, and that is kind of lower the risk in case it turns against us. Because at that point, we'll have brought in that credit, and if it does turn against us, we'll be losing money at a lower rate than we would if we still had that 80 delta. Okay? Does that make sense? So that's if it's going quite well there on this. Now, Gazelle asked a question. What if we're going to get out of it? What if the things are going well? Because very often in this webcast, you've seen me, if you've watched me before, and you've probably seen James at some time do this as well, and that is put in an exit where you get out if we hit a certain target price. Yeah, we can do that, but the intention of this trade is that this is a trend trade, and that my expectation is I'm going to stay in this for this purposes of this class. We're going to stay in this as long as it continues to trend up. Now, we may move that stop loss up along the way, or we may move that stop loss along the way to tighten it, to help capture in gains, so to speak. But as long as this is trending up, I'm going to stick with it. Now, if this were a swing trade, okay, if there were a swing trade and I was doing, say, a flag pattern, what I would probably do, let me change my color here on this so you can see it a little better. What I would probably do is I'd probably take my flag pole, which is that, little crooked, but you get the picture. There's my flag pole. And what I would do is I would take the length of that flag pole, that length, and we could add it to the breakout and use that as a target price on there. But in this case, I'm not doing that. What my expectation is, hopefully, The goal is for this to go up, maybe flag a little bit, go up, flag a little bit, and stay with it as long as that happens. All right. So that's why I'm hoping that answers your question there, Gazelle. Good question. And I want to look at other examples here, but that's our first example. That one's a bullish call example here. Let's look at a bearish example. Let's see. Let me check out questions here. Is there a strategy or term where you buy? Is there a term of strategy where you buy a long contract, say at 60 delta, goes up to 80 delta, you roll out 240s if still bullish, if mini. You can, okay, so this brings up a bigger question, but it's a good question. If I do one contract, say at an 80 delta, in a sense, there's a lot of similarities to doing two contracts at a 40 delta, okay? Now, the cost of 180 isn't necessarily going to be the same equivalent cost as two at the 40 delta. But the net delta is still 80 on this. So the delta is the same, but the initial cost may be different, okay? The theta the time decay is going to be different, okay? So, you know, I think that's probably as far as I'm going to get into it right here, but you can explore that possibility, George, who had a good question there. But there's more to it than that. You're getting the same delta equivalent, but you're not necessarily getting the same theta equivalent or the same vega equivalent or the same cost on that. Okay, so there we go. All right, let me go on. Let me just hit one more question here, Gina. What if your delta is high but the theta is only one? Still good to stay in. So in this case, with long options, we know theta is going to work against us, okay? We know it's going to work against us. Typically, if the delta goes up, okay, as we get more in the money, and if we get that 80 delta, one advantage of that is your theta is probably going to be less because you're more in the money at that point. And typically, your theta is higher when you're at the money than farther in the money. So that is one downside. You are correct, Gina, to bring that up. That is one downside of rolling down to it. But, you know, keep in mind of what's going to affect the trade. Stock price, time, volatility, interest rates, whatever. If your stock is trending up pretty well, the theta is probably going to be a smaller factor than the stock price move there. Now, if the stock is just kind of languishing and going sideways, then that theta becomes a bigger issue. But if it's moving for us significantly, it's just the price of doing business. Okay? Price of doing business there on that. So good point. I'm glad you brought that up. And that's why you guys are so great in the chat. You bring up things that I probably should have maybe thought to mention, but I didn't. But your questions are reminding me of that. Let's look at maybe a bearish trade. Okay. So here is Union Pacific and trend. Well, I'd say going down. I mean, I think we have lower highs, lower lows. Here's our 20-day moving average, clearly sloping downward. We're below the 50. Price action, well, yeah, it went down, went up, went down, went up. Now kind of a bearish, you know, I'd say the price action's more bearish than bullish in that case. And so let's look at UNP and look at a bearish trade. Now, I went 52 days out on that previous one. I can go to 87 days. I can go to 100. Well, I can go to anything. But in terms of our trend trade, the reason why we typically don't do trend trades on 38 days is this. Let's say we were to do a trend trade on 38 days, and even more so 31 days. Usually we don't want to hold it all the way to expiration. Once we're getting under the month mark or so, you know, really that theta is ramping up, and again, it's working against us. So usually we're looking to get out before that time. And for a trend trade to develop, look, a swing trade, let me abbreviate this, swing trade, usually we're looking at a trade that is days to weeks, okay, days to weeks in length. Intermediate term trade or a trend trade is weeks to months. Okay, so if my trade is going to last at least several weeks, okay, at least several weeks, well, that 38 days probably isn't enough to factor in the several weeks of time plus then some. The plus then some is however long you think you're likely going to be in that trade. And of course, we don't really know on a trend trade, but our hope is several weeks. That's not giving us several weeks plus at least a couple weeks of buffer there on that. That's why typically on trend trades, we're going out 50 days or more on that. 87 days would be fine. Let's change this up a little bit. Now, if we do, let me get fewer strikes here because I want to point out something. If we compare the 52 days to the 87 days, theta is going to be a little less going out further. Okay, there you go. Deltas will be a little bit different too. We've been talking about delta. Let me just mention this. And this isn't a huge difference. You'd see a bigger difference if I go to, say, if I go to look at something even with fewer days till expiration. But let's look at our delta here. We'll just pick on the 230 strike right now. 61 delta here, 230 strike. Well, it's basically the same here on this, okay? Let's go, let me show you this though, okay? As we get closer to expiration, we'll go out 17 days, okay? 230 strike, what did we say? We said 61 delta, 230 strike, 67 delta. Yeah, notice delta is a little bit higher as you get closer to expiration, okay? We could go to the 3 days out. 230 strike, oh, delta's even higher still. Those contracts that are in the money, as you get closer to expiration, the delta is going to go up. Okay, we talk about delta moving based on the stock price move, but even if the stock price isn't moving, delta can move. If those contracts that are in the money are going to get a higher delta as you get closer to expiration. Those contracts that are out of the money are going to get a lower delta as you get close to expiration. And contracts that are at the money are probably going to have a delta pretty close to 50, regardless of how long you are till expiration. But delta does move based on how long till expiration. Delta, by the way, if you think about an expiration, everything's either a 1 delta or 0 delta. It's essentially how that works. Okay, let's go to 87 days. Let's go to puts here. Same thing is true. I've been kind of looking at the call side of things. Same thing is true on puts. Out of the money, deltas, just put the negative sign in front of them in the money. Okay, I'm going to do the same thing. I'm going to go to 65 delta because that adheres to the rules that we often teach in this class in terms of swing trades. This is a bearish trade. I'm going to double check here. Now look, our open interest is 612 on that. Okay, it's okay. Spread is about 70 cents, which, ideally that would be tighter. Ideally it'd be tighter. Now, when you're dealing with the more expensive stock with more expensive options that are in the money, on a $14 stock, that is it's probably less realistic to get a 10-cent spread or something. Maybe if you're looking at Apple or something like that, you may get that 10-cent spread, 20-cent spread, but on most stocks, it's probably less likely. One thing we can do though is I'm going to right click and let me just buy custom with stop. This is a bearish trade. This is a put trade. Look, our natural price is 1460. Our mid price is 14.25. If I go, we can pay perhaps a little cheaper. If I go all the way to the mid price, it's probably unlikely, unrealistic for it to fill. But I probably don't need to settle for the natural price on this. So I'm going to go, I'll split the difference there. Now, before I do this though, let's talk about that stop. Let's put that stop in a little bit of a different way than we did the other one. Our anticipation, this is a bearish trade. My anticipation is this is a bounce that we just bounced off right here. Let me zoom in just a little bit. That we just bounced off right here and that it's going to go down from here. If we're wrong, we're wrong. And maybe it, maybe it goes up. So what I'm going to do is I'm going to say, I want to exit. I'm not going to put this based on the stock price, option price. I'm going to put this one based on the stop price. The stock price. Stock price. I need to enunciate that. So the high, I'm just going to actually tweak this a little bit. I'm going to move this up to the high, where the high is there. So that's right around 237, 230. We'll give it a little wiggle room here on this. We'll say, maybe we'll give it up around 240. If it goes above 240 though, we're going to get out of this trade. Okay, because if this goes up to 240, if the stock does this, then my whole thesis of lower highs and lower lows is breaking at that point. My downward trend idea is kind of going out the window at that point. So therefore, I'm going to look to get out. So how do I do that? Let me go back here. I'm going to make this market good till canceled. When I do that, it's going to give me an error message. Market order must have daytime in force. There's an exception to that, and we're going to use that exception. The exception is if you have a rules-based order here on this. Okay. Now, and we wanted to get out if it goes above 240. Okay, above 240. UNP marks greater than or equal to 240. Save. There we go. And just realize the risk on, what's the risk on this? Well, I don't know. We can see, we can use the Thiel price, for example, and say, what if the stock goes up to 240? What do we got here? Well, let's take a look here. First of all, I'm just going to send this. Confirm and send. We'll put this in this bucket here. Send that order. Okay, that order filled. And let's see. Oh, if the stock goes against us up to 240, how much is this option going to be worth? Well, we did the 245. You can see that listed right here. June, I can go to Thiel price, add a Thiel price here, and say, what if the stock goes up to 240? Let me reset that first of all. Now that's about a $5.20 gain in stock price. I'm not going to be exact here. 520, and we'll assume that doesn't occur instantly. We'll say it takes a few days there. Okay. So now when I do this and I look at this, remember, we're getting in around 14 bucks. Our price would go down, our expected, our anticipated price on that option, a little bit below $11. That's a decent loss, but it's not guaranteed. This is just a probability. It's not a guarantee there on that. But there's two trades for you here. Okay. Now, let's just kind of look. I may not go through the full trade, but let's just look at some others as potential trend type trades. Let's do another bullish one maybe. Here's one that we don't really do very much. It's expensive stock. I put in the symbol wrong. That's why. Okay, so Berkshire, you guys are familiar with Berkshire. Bullish trade. Well, let's use the methodology. Trend, yeah, I mean, I'd say that's an upward trend. We're above our moving averages. Support and resistance, I'm not seeing much in the way of resistance, okay? And a price action. Well, we had a bounce, okay? Kind of a flag pattern, wouldn't you say? I'd say the general trend was up, flagpole, flag, and there we go. So this is that a bullish position? This would be more of a bullish trade. To answer Isaiah in the chat, is this more of a bullish trade? Yeah, because remember, the first thing we're always looking for is a trend here in terms of technical analysis. That's the trend. Okay. So there we go. And so yes, as James pointed out in the chat, the Berkshire's kind of is familiar to a lot of people. Well, I mean, it's a big company, but it's a holding company. They hold a lot of different things, but famous for Warren. By the way, just a little Warren Buffett. If you are interested in the A shares instead of the B shares, there's your price tag on those. Okay. No, you're not misreading that. That's $792,000 here. So that's what happens when stocks don't split. Well, stocks that are very successful stocks don't split. Well, that's why we have B shares here. So we're not going to that was just a little side note. Okay. All right. UNP. UNP was a long put, Isaiah. UNP was a long put. Long puts are bearish trades. Okay. And remember, we're going with the trend on those. And so this one, the trend is up. Okay. Looking at a bullish trade. Again, double check liquidity on your trades. You can go out farther. We can do leaps, but leaps are going to be more expensive. Here we're trying to, but one thing to remember is this. If I wanted to buy 100 shares of this stock, okay, how much would 100 shares of this stock cost me? 100 shares of this stock would cost me $52,000. $52,000. Okay. Now, you don't have to buy 100 shares, but if you were to buy 100 shares, $52,000. If we were to do, say, the 520 strike call, how much is it going to cost us? It's going to cost us about $2,000. Okay. So you may be going, well, that's an expensive option. Yeah. Now we're not getting the same dollar for dollar movement on this. 100 shares of stock is 100 delta. Okay. So we're getting 100 deltas out of that. This $2,000 investment, we're getting 64 deltas out of. Okay. So when we talk about leverage, that's what we're talking about on these for leverage. Now, doesn't mean that I'm not trying to say, oh, you need to use options for that reason. Leverage can work for you, can work against you. You can lose that $2,000 very quickly. If this stock goes down 10%, this option is going to be worthless probably, right? The stock would be worth about 10% less. So there you go. So there's another example. I'm not going to enter this trade right now, but that's another kind of example. Look for your bullish trades. Look for your bearish trades as a starting point on these in terms of trend trades. But remember, if these trades do well, so here's maybe a trend that's down, okay? FedEx, gapped way down on earnings. It's kind of recovered a little bit, but the trend isn't broken. That's still the trend. On either of these, we've got AIG, we've got UNP. What we may consider doing, here's our delta around 63. If this hits negative 80, we may consider rolling that out, taking some of the risk off the table, bringing in a credit, and there you go. So that's there's some examples, some trend trade examples today. I want to thank James for helping me out on the chat, of course. Encourage you all to subscribe to that Trader Talks channel on YouTube. Coming up next, we have getting started with technical analysis. Great trade. Remember, you can always follow James or myself on X at BrentMooreCS, at James Boyd CS. And there we go, everybody. Everybody have a wonderful rest of the day. We'll see y'all same time next week. Bye-bye, everybody.